Hey everyone, it's Moshe. I hope you had a wonderful day. I want to take a quick minute and discuss the hot topic around the day surrounding the Fed meeting, which started today. It's going to commence tomorrow, and they're going to come out with their new interest rate policy. Most of the financial markets are anticipating and assuming the Fed is going to hike rates by 0.5% tomorrow, 50 basis points. What I've been getting a lot of calls and concerns about is, hey, Moshe, does this mean that when the Fed raises their rate tomorrow, that now mortgage rates are going to be 0.5% higher? That's not the case. In fact, when the Fed raises their rate, their federal funds rate, that's more closely connected to short-term borrowing, such as when banks borrow money from the Fed or lend to one another. Also tied into that is short-term debt like credit card rates, home equity lines of credit, car loans, student loans, things of that nature. Mortgages, which are considered to be longer-term debt, are more closely connected to the mortgage-backed securities market, which actually, contrary to popular belief, when the Fed comes in and raises interest rates, in the long run, we've seen that mortgage rates do well and react favorably, meaning mortgage rates will get lower over the course of time after the Fed coming in and hiking rates. The simple, quick answer to this is that when the Fed steps in and hikes rates, it's deemed to be anti-inflationary, that the market senses that the Fed is doing what they can to get ahead of inflation, curb inflation, and keep it from really running out of control. And therefore, when somebody is coming in to invest in a fixed asset like a 30-year mortgage bond, if you're investing $1,000 today with the hopes of getting paid back $2,000, if you are of the impression that inflation is going to continuously get out of control, instead of getting back $1,000 for your initial investment, you're going to want to get $2,000 back, right? Because if inflation is out of control, that simply means that the cost of goods are going to be that much more expensive in the future. So $1,000 of a return is no longer going to be attractive enough for people to want to invest in that asset. Therefore, mortgage rates go up so that investors can get a higher yield of return on their investment. There's a lot more to it, but that's kind of just a short gist of it. Stay tuned for tomorrow when the Fed actually does their announcement. We'll see how the financial markets react to that. I'll be back with a little bit more tomorrow. Talk to you soon. Have a good night.